Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question comes from Ben, who has a question relating to dividends. Alan, thanks for TRN. I've been doing great with this stock since it was published in your stock reports. I recently sold the $40 call option and noticed on the premium report that the ex-dividend date is July 11th. And I'm worried that it may be exercised early. How could we tell if early exercise will occur? Thanks for all your information, and it's signed Ben. Well, Ben, I'm actually glad you asked that question because recently a lot of our members have inquired about dividends as it relates to covered call writing, and that's why I selected your question for this Ask Alan video. So in order to make some sense of this and determine the likelihood of early exercise, we must first access the dividend information. So in the screenshot in front of you, you could see here that I highlighted in yellow that the ex-dividend date is July 11th. You sold the July $40 call, so the ex-date is before the July expiration. Now, the ex-date is the date that you must own the shares in order to capture that dividend. So if the option holder wants to capture the dividend, he has to exercise prior to July 11th. Now, I highlighted in pink below that the dividend amount, which is 10 cents per share or $10 for the contract. Now, if you look below that, you could see that the previous dividend amount was 15 cents, so it would seem like they actually decreased the dividend, but that's actually not the case. If you look a few rows above that, you could see that on June 20th, there was a 2-for-1 stock split. So we'd expect that 15-cent dividend to be cut in half to 7.5 cents, but it actually came in at 10 cents. So at the time of the split, not only was there a split, but also a dividend increase. So $10 per contract is what we need to keep in mind. That's how much the option holder can capture if he exercises early prior to the X date, owns the shares, he will capture a $10 per contract dividend. Now, to determine the likelihood of early exercise, we have to take a look at that $40 July call option that you originally sold and see the value of that option to figure out whether or not there's a good chance for early exercise. So let's have a look at the options chain, which I captured as I was responding to your question and creating this video. And here you could see that the $40 strike has a bid of $3 and an ask of $3.30, a 30-cent spread. So I believe that you could negotiate a better price than $30 if you were the option holder and selling that option because of the wide spread. So I'm going to use $3.10 as an amount that you could negotiate. Now, for those of you not familiar how to negotiate better prices with market makers, I suggest you take a look in my complete encyclopedia for covered call writing. Look in the index for playing the bid-ask spread, and I explain how to do that. So we're going to go with $3.10. As a matter of fact, if you look all the way over to the left, you see the last trade was for $3.15. So we're going to go conservative with the $3.10. Now, of that $3.10, $2.91 is intrinsic value, the amount that the $40 strike is in the money, not profit. So the difference is 19 cents. That's your time value profit. So if the option holder, instead of exercising early, just sold the option, he would generate a profit of $19 per contract. If he exercised and bought the shares, he would generate a dividend of $10 per contract. So as you could see, it does not make sense for the option holder to exercise early. So let's have a look and see how we evaluate this as to the likelihood of early exercise. Now, in this case, the answer is it should not be exercised early, but it might be. So let me explain. If the option holder sold the option, he would generate twice as much money for selling the option rather than exercising early, $19 per contract versus $10 per contract. Not only that, but early exercise will require the option holder to lay out all that cash to purchase the shares, thereby enhancing his risk, the risk of having more money in the trade. And in addition to that, the cash used to purchase the shares can no longer earn interest. Now, interest is very low at this time, but nonetheless, it is still interest. So if you notice that it seems like there's just no way that early exercise will occur, and I wrote it may. And the reason for that is that many retail investors do not understand the relationship between ex-dividend dates, dividend amount, and time value of option premiums, and that's one of the main reasons why I decided to make this video. So a determination can be made by you, the covered call writer, as to the likelihood of early exercise. In this case, highly unlikely. However, it could happen, and if a retail investor should decide to exercise early to capture a dividend, I frame it in my seminars. It's like spending $1 to make 50 cents. Well, in this case, the Options Clearing Corporation will get that exercise notice, and then we'll randomly assign it to a brokerage. It may be our brokerage, it may not be. And if it does go to our brokerage, then the broker will randomly assign it to one of the clients, and it may fall into our lap. And that's how it may happen, although it's highly unlikely. So, Ben, thanks for that question. It's very relevant because so many people seem to be interested in dividends at this point in time. So I hope my response answered your question. So I thank you very much for that question. And, of course, thanks to everybody out there for taking the time to watch this video. Hope you enjoyed it, and I hope you found it useful. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.